Well, we should probably get started here. Um, it was asked at the beginning of our last meeting, or at least it was voted upon, I guess is what I should say, that we do a little bit of financial modeling at the very beginning of each of our meetings here. So I'm going to dive right into that here. And let me actually give me one moment here to bring up this document. All right. So I have started putting together, I'll share my screen, a series of small 10-minute courses or less if I can possibly do it. And the whole goal here is to actually start giving you the spreadsheet goals in order to create your own financial models, spreadsheet skills. And so we're going to be talking about in the commercial space, a lot of the calculations that I think most investors don't really know unless they've been working in the commercial space. And a lot of these too are applicable to not only residential, but also to businesses. After all, if you are looking at buying, your local FedEx store, there's an income and an expense statement and net operating income. Usually the business is valued on a multiple of the income. And so in many respects, evaluating a commercial property is very similar to doing M&A in the business world. But these are the topics that I brainstormed and just started putting together small spreadsheets for. So the first one is how do you calculate cash on cash over a 10-year time period? How do you calculate the IRR? How do you calculate the equity multiple? We'll talk about what is cash flow and appreciation and how those are modeled, how the hold period affects your analysis, what are the effects of leverage on an investment, what are the financial terms, what are the effects of interest-only payments when you're talking about a commercial deal. We'll talk about NOI growth, the rehab budget, exit cap rates, fee structures, taxes, and of course, waterfalls at the end. And really, each of these is meant to build upon the next and add another, dimension that you can capture within your financial modeling. And I'll have a little financial worksheet for each of these. And so you can see my screen right here. Let me see too. Are we getting more people in now? What are we up to? 26. Oh my. Okay. So, how many people here, and why don't you go ahead and answer in the chat? How many people here are familiar with what a cap rate is, or at least they feel, maybe I should say not familiar, but feel comfortable with using them and talking about them and discussing them? If you do, put a 1. If you don't, put a 0. And I'll start here. And then the second thing that I'll go through, if we have time, is a small cash flow analysis. And what I want you to note about each of these is that I put a lot of information here about what the particular metric is. And you can see here the metrics that I just showed you. I've got one tab on this spreadsheet going all the way across here. So we'll do one tab each week as an intro to the club. And so let me look at the chat. All right. Okay, so we've got a good mix, but most people, I would say, put a 0 in, so that's not familiar. Okay, so the cap rate is one of the most important metrics that you can use in commercial investing because it is so foundational to the idea of pricing a commercial property. When we're looking at a residential property, the way an appraiser appraises it is they come out and they say, hey, you've got 2 bedrooms and 2 bathrooms, and there are 8 others near you, and they're valued at about this, so yours is valued at about that. And they'll make a list of amenities and kind of jigger the price up or down based on your list of amenities. Well, in commercial properties, you usually can't compare one property to another. They're different room sizes, they're different qualities. Maybe one has a gym, one has a pool, one has a tennis court. So they have different amenities. They could be radically different properties. And so instead of evaluating them based on features, you're going to be evaluating them based on the amount of income they produce. And so the cap rate is simply the ratio of the value of the property to the amount of income that they produce. So I've got a complete explanation over here, little map here. In California, it's common for cap rates to be what we call compressed, which means they're low. In places like Alabama, they might be quite a bit higher. And I actually did go to Mashvisor and pull off a June listing of what cap rates are in a variety of different cities around the US right here. So you can kind of see, Palm Springs has got a very high cap rate apparently. And what that means is that the price is low in comparison to the amount of income that it produces. So here, for instance, if you want to play around with the cap rates, as soon as I give you the link to this, you can say, hey, what if I have a $1 million property and it's making $50,000 a year? Well, then the cap rate is 5%. Or if I have a 3 million, then it's a 1.67%. So cap rates are important because different cities tend to have different known cap rates based on the income the properties produce there. And the way that appraisal happens within commercial properties is that you simply take the amount of income that you're producing and multiply that, or divide it rather, by your cap rate. And that gives you your property value. So it's the appraisal method for finding out the value of a commercial property. And this actually applies to, multifamily, industrial properties, data centers. There are different income line items and expense line items in each of these. But valuing the property itself through the income method of appraisal is really this simple. What is your total income? Divide it by your cap rate. That's your value. And so that I'm going to stop there. Next week we'll do cash on cash, but I'll make this spreadsheet available so you can look through the cash on cash too right now. But this becomes very important because in the calculation, you're buying it at a certain cap rate, and then you're selling it at a certain cap rate. And what these cap rates are will finally determine how much price appreciation there is. So in this case, from 1,000 to 1,200 in this little setup. I'm sorry, 1 million to 1.2 billion. So that is your financial modeling minute. And with that, I'm going to hand it over to Zasha. Zasha, welcome to the group. Tell us a little bit about yourself. And are you there?
Here. Hello, okay. Everybody. That was welcome. A quick tip, quick run through. Thank you.
Yeah, welcome to the group. And feel free to introduce yourself and tell us what you do.
Hey, aloha, everybody. Happy Veterans Observed Day. My name is Zasha Smith from Maui, Hawaii. I do have a little presentation for you guys of some creative ways to invest in real estate and just telling you guys a little bit about my journey. So I will just start sharing my screen. Okay. Present. So creative ways to dominate in real estate investing. These are just some strategies that I'm using and utilizing today with the interest rates being so high. I do all sorts of types of investing, so we're going to run through those as well. Quick disclaimer, this is only for informational purposes only. Conduct your own due diligence, which I'm sure he has already run through as well. So my story, I grew up in Hawaii. I still live here today. I'm actually in Maui right now. I just came back from speaking at a conference in Texas about raising private money through social media. We talked a little bit about that in the beginning of the call, but it's very interesting that even people that you meet virtually, and I'm sure you guys have experienced that as well, want to find out different ways to grow their money or to invest. They just don't know anybody that's doing it. And so you being the face or somebody who's consistently talking about it definitely opens up a lot more doors for opportunities. And so I graduated from Maui High School and then went to Cal State Long Beach, got a degree in civil engineering and worked as an engineer for 10 years. I'm still licensed to this day. However, just working the 60, 70-hour weeks got tiring. I had 2 kids, a husband, and I started going in 6 days a week. And so that kind of was what do they call it? Like that, I was at the end of my rope with that. I was already managing projects, shopping centers, hotel renovations, underground utilities for subdivisions. And it was just a lot of stress as well. So I decided, like any millennial, to Google how to quit my job and get rich. And I found a lot of people owned real estate. And me being in Hawaii, a very expensive market like California, I was like, oh my gosh, it was so hard for me to just buy my own property. How was I going to buy rental properties? It didn't add up in my mind. And so I started listening to Bigger Pockets, and then connected with some investors that were on Maui, seeing what they were doing, and that showed me that was possible. And so I started buying properties on the MLS, purchased my first fixer-upper in 2018, and then bought a few more. And really, I was using conventional loans, and so I didn't know how to get creative. And so I joined a coaching program. Ryan Pineda is now a wealthy investor, as one of his first students. And that really taught me that I had the ability to scale more, and gave me the confidence, because I was around a network of people that were doing it full time. And I wanted to quit my job. Like, I loved the opportunities that it gave me. However, I knew it wasn't my passion, and I knew it was meant for more. And so after when 2020 hit and we went through the whole C word, I don't want to say it, but we went through that downturn, I ended up quitting my job. And then this is kind of where I'm at 4 years later. This is a picture of my mom, my brother, and my sister when we were growing up. And currently, I'm a full-time investor now. I have a $5 million residential portfolio, mostly in Hawaii, single-family, multi, short-term. So I kind of do a little bit of everything. I fixed and flipped over 21 projects. I have 6 more. And in the last 3 years, I've raised $7 million in private investor funds, and moved over to now commercial investing in January 2022, became a general partner of several apartment buildings, and then started a debt and equity fund. And also became a micro influencer along the way. So for those who don't follow me on Instagram or have an Instagram, scan this QR code. It links you to my page, Invest with Zasha. And really the intent there that I had with starting my social media platform was to get deals and raise money. It's definitely done that, but also led to several other opportunities as far as making affiliate fees and expanding my network, now being able to speak on stage and share my story. So you never know what post will reach someone. And I honestly love it, because you get to showcase a little bit of who you are. Of course, people, building that know, like, and trust factor is huge and important, but people want to honestly know who you are as well. Like, what are you doing day to day? Like, what are your values? What are you doing? Like, what are your hobbies and habits? So it's very interesting that maybe it's just an American thing, I don't know, but people are just curious about you. And so the more that I share, that more rapport I build, and the more people want to invest. And so today I'm going to be talking about creative financing, and that's what I've had to leverage, especially, like I mentioned, being here in Hawaii in an expensive market. And you don't have to worry about the interest rates. I just applied for a conventional loan because we qualified. And so I was like, hey, let's see if we can buy another rental property conventionally before the end of the year. And so I got quoted as an investment property, 7.75%. I had to buy down to that interest rate 4 points. So it would have cost me like $6,500 each point. And then I think my mortgage payment was going to be $7,000, but then the rent I could collect on that property would only be about $4,000. So my offer got accepted, but we didn't end up pulling through with it. And so that's why knowing about creative strategies, especially if you are buying properties on your own, is super important. So it's no secret, I think when you can go direct to seller, it's a lot easier to offer these different strategies because it's not the norm. And so some milestones that have helped me build a portfolio creatively was really defining my goals. Like, what I know you guys are here today learning on a holiday. So first, I know this is very basic, but just knowing how much you want to make a month will help you then determine what your goals are and what you want to do and how much time you actually have to invest versus how much money you actually need to make. And so on my first property, here's just an example of my first flip. I acquired it through a foreclosure auction. So this is when I was first starting out. I didn't know much about buying off-market properties, but I ended up going to the courthouse steps and I didn't really know the process. However, because I was just networking with people there, met attorneys, and just put myself out there, I got to know how it all worked and ended up buying this condo in 2019 for $300,000. And then the rehab was only 30,000. I did make a lot of mistakes during that time. However, I was like driving to the landfill, the dump, like I was pulling weeds. I don't know. I thought I had to be in it to start being a real like real estate investor. However, now I know that's totally not what I want to do anymore. But that deal changed my life. We ended up the net profit on that deal was 103,000. And I did it at 30 days to renovate, 15 days to sell to a cash buyer. So that was the big eye opener in 2019, which I was only making $70,000 as a civil engineer project manager at my job, which took 365 days. So after that, it was kind of like, hey, if I just do one of these a year, I could replace my income from my job. So that was my light bulb moment and changed everything for me. And so I used that profit while I was still working my full-time job to invest in more rentals, use the BRRRR strategy. At that time, the interest rates were lower, so it made sense to do the cash out refi. And then I would use that extra like 10% of equity and a home equity line of credit and then invest that into another property. So it was more of recycling the same money and growing my portfolio. That was really how I envisioned how I was going to scale. However, I could only do one property at a time. So I started partnering on bigger projects. We bought in 2021, I partnered with one other person on a 15-unit office building that was seller financed. Which that also opened up my eyes to, oh my gosh, what is seller finance? Why would somebody do that? So I'm going to explain a little bit more about that. A 48 pad RV park, 100, plus apartment deals, and just had the similar benefits of owning rentals, but then without all the headaches. And honestly, partnering with other people and sharing that roles and responsibility and having extra eyes on things, I think really helped me to grow quickly, because if I was trying to do it all on my own, it would have took me years. And for me, it was more important to cut that learning curve. Even if, you have to give up some of that equity in the deal, it's totally fine because you have other people that are keeping eyes on it and you don't have to know everything. I think that was my biggest takeaway was like, I didn't need to know every single number. I didn't have to know how the renovations worked, through and through, but I did have to have partners on my team that needed to know that. And so if you wanted to do creative financing yourself, you could find a deal by calling brokers, calling wholesalers, going to auctions or meetups, and actually meeting other people who are doing these types of creative strategies. And so understanding the market, dive deeper into what their motivation is. So a lot of times when you're dealing directly with a seller, they may be going through a distressed situation, which may lead them more open to doing certain strategies, which I'm going to go over.
Zasha, I forgot to tell you, if you want me to interrupt you so that if there are questions put into the chat, you don't need to look at that. I'll interrupt you unless you want me to hold them all to the end. So
yeah,
would you? Yeah.
Whatever you normally do?
It's really up to you. We often take them as we go.
Okay.
But it's up to you, the speaker. You want to take them?
Yeah.
All right. Glenn is asking, Zasha, there are so many people that suggest creative financing. What is your view on actually finding these? The infomercials make it sound like it's available everywhere, but to my experience, it's rare to find.
It definitely is rare. It's not going to be something that's put out there intentionally. A lot of times you have to find something off market. So when you're dealing directly with a seller, you can see what their situation is. I'll share in the next slide about the Novation strategy. That was an off market. I dealt directly with the homeowner, and even I got seller financing dealing directly with the homeowner. Or if a property is listed on the market and they want a price that they're not getting, you can have some leeway with negotiating different strategies, as long as you know how to explain it to them. I feel like even now, since home sales are slowing a little bit in majority of America because of the interest rates, they may be open to different types of strategies. So the one that works the most for me in Hawaii is the Novation strategy. So I'll go over that here. But yeah, it's totally not an infomercial thing. You can do it, but it's not how I do majority of my deals. It's just an option in order to still find deals in this market. So here's the Novation strategy that I use. So the situation of this seller was that they were in pre-foreclosure, and their house, they were semi-hoarders. And so they didn't want to list it with a realtor because they didn't want people walking through their home. And so I had suggested that we partner together. And so what I did was I brought the rehab fund. So I had a private lender bring $200,000. I paid them their interest at the back end. I partnered with the seller, so they kept the home in their name. I brought the funds to rehab the property. And when we sold it, we had agreed upon them getting the 450, and then I would get, whatever the profit is on top of that. And so they walked away. I think their mortgage was 200 something thousand. So they walked away with 200. I walked away with 200, and they were fine with it. And how this works is I didn't know how to partner with a seller. I just went to the escrow company, the title company or attorney, depending on what state you're in. And I said, hey, this is what me and this homeowner want to do. How do we legally go about it? And so they wrote up they put a lien against the property for that 200 that I was into the deal, so that even if they tried to sell on their own, they would have to pay back that money. And then I also they had suggested, this is in Hawaii, that I take power of attorney over any decisions that are made for the property. So I could sign it over to sell if I wanted to. However, legally, they advised me that to have the sellers sign all the documents, even though I had the power to, because you don't want to get into a situation where they said, oh, well, we never seen that document. Oh, she coerced me. I even had to sign a letter stating that because they knew the property was worth so much and decided to sell it to me basically at half the price, that they were aware that they're selling it to me at a huge discount, and they weren't forced or tricked or anything like that. So there's a lot of other stipulations that could be put into place. That's why I highly suggest, before doing any of these creative strategies, talking directly to the attorneys and the title companies, because they'll know what exactly needs to be written up in order to not only look out for yourself, but also look out for the homeowner. So this was my biggest profit to date. And then this is a property in Hawaii on the golf course. It's beautiful. I actually wanted to keep it if I could have afforded it. But what's crucial in these types of situations is knowing what their financial situation is. And so it's not going to be somebody who wants the highest price on their home who is not motivated. They can just list it with a realtor and, get a cash buyer or get a conventional loan. So those are not the people that you're going to target. You're going to, I wouldn't say target, but look for people that are in some sort of distress. For example, a seller finance deal that I did was one in Wailuku, and the owner was hesitant on listing it, but I knew the realtor who was involved in the transaction. And so she had contacted me and said, hey, I have this seller. He's hesitant to list it because he doesn't know what to do. If he gets this huge lump sum of money, then his wife, who is in Medicare or in a home their monthly payment is $2,400. And so if he shows like a huge profit from the sale, then her payment for her, I don't want to say Medicare, but her housing in that facility would go up to $10,000 a month. And so I said, well, would he be open to financing it if it's owned outright? And so we negotiated so that my monthly payment would be $2,400 a month, and then he would hold the note. He would then record a mortgage for the amount that I was purchasing it from him, and then I would just make monthly payments until I either flip the property or if I wanted to refinance and get a longer term loan. And so it's a 5-year loan. I believe it was at 7%, and we've been extending it every year. So every year we kind of see where we're at, and he's actually open and flexible, and he's glad. He just seen the payments coming in every month, and that covers, you know, his wife's care. So he's happy to get paid out, you know, whenever the situation arises. And so, like I mentioned, what's their motivation? They could be a tired landlord. What's their timeline? Do they need to sell right away, or they looking to? So this particular home that I'm talking about was vacant. There was nobody living in it. He owned it outright. It was old. It needed to be teared down and a new home built. And so he didn't want to go through that process either. He's a lot older. And so whenever you can talk directly with a homeowner, you'll have more of a chance to implement these creative strategies. And then, like I said, just building rapport. I think at the end of the day, whenever I deal with homeowners or sellers that are in distress, I'm very mindful of their situation. And I say, look, like, if you need to talk to a realtor or you need a lender to help you in your situation, or you need a different sort of strategy or want to keep the house, maybe if you want to talk with your family, you know, I can be there, but I'm really the last resort, because if you sell to me, I'm going to have to make a profit. And so I have to get it at a particular discount, or we have to come up with a creative strategy in order for me to buy it and make sense. And so some questions to ask them before you start negotiating this creative strategies is really like, what's their interest rate? How much do they have to pay off? Any liens, insurance? And then from there, you determine what cash flow you're comfortable with, knowing all of these items. And so what's been really big for me is raising private money. So raising money from everyday individuals who want to invest in my real estate deals. And I believe he said you kind of already know what this is. And so it really comes just from building relationships with people in your circle, virtually, online, at meetups, just whoever, you know, is out there and is educated about private lending and knows the risks and are open to it, could invest in your deal. So my first private lender lent me $560,000 on a really great deal in Kihei. And so he was an investor. And because COVID had happened, he was like, hey, I'm going to pull out. Like, I'm not going to be buying anything right now, but I have a lot of money and I want to lend it if you find a really good deal. And so we negotiated that. And he didn't want an equity split. He just wanted a straight 8% return, no points. And I was all for it. But he was honestly, because he was an investor himself, he was hoping that I didn't make the payments because I got such a good deal that he wanted to actually take over the property. So it's kind of crazy. But key things to know about people when you're raising money is their net worth, their assets. You know, do your due diligence on the property itself, and just making sure that at the end of the day, once you get it under contract and you need to sell it, making sure that there's a lot of equity just in case the market fluctuates. So here are some different strategies. I already kind of walked through the Novation strategy where we signed the contract, we opened escrow, listed it. So this entire time, the property is still in the original owner's name. And so like I mentioned before, the lien against the property with the promissory note, and then also the oh my gosh, what was it called? The power of attorney gives you the comfort that, you know, if they do try to sell it or or they decide not to sell it, you could actually enact that and then move forward with the project. And so that's how you make the profit, is you sell to a different end buyer. Then a seller finance deal is when the property is owned outright. You could give them a down payment and the seller would be in the first position lien, then you make monthly payments to them, or you could negotiate, making payments to them afterwards. There's no set terms, so no interest rates, no down payment, typically that is set for them. It's almost like, when you walk into the bank, they set all the terms. When you're dealing directly with a seller who owns a home outright, you can set whatever terms works for both of you guys. And then there's also subject to, where you can take over the title of the property and make payments to the existing mortgage. And then the seller, if you want that, also you negotiate that, but you do have you may have the bank call the note due if they find out what you're doing. So there is a little bit of risk involved in the subject to creative strategy. And so in short, these are some of the ones that I use the most. There's probably a lot more other creative strategies that you can do, but I've done this here in Hawaii in an expensive market. I feel like there may be more deals, or I've seen more deals where you can get creative, maybe in lower price markets as well. And I would just check even with your realtor or somebody who has access to the MLS. You can search, I think it's owner financing, seller financing, or search some of these creative terms and see, or taking over a property, and see if you can, because I've seen more recently some listings that say that they will be offering some sort of financing or even like a seller credit or buy down, like right off the bat, because they know people are struggling to get these loans. So next steps is think ahead, determine your goals, learn and grow, plan financially and legally, making sure that you are planning what your next steps are going to be, and dedicate time and educate yourself. So you're on this call today because you know that there's something to this real estate thing, to investing. You're just kind of, going through the motions, but being inspired and learning. That was huge for me, is getting a mentor and just really knowing that it was possible. So mahalo, everybody. And I will, if there's any other questions, I can stick around. But my whole goal in all of this is to build wealth while making an impact. So it's my pleasure to have the opportunity to speak to you guys today from the little island in the middle of the Pacific Ocean of Maui. And I hope that this brought you some value.
And mahalo to you too. And it's amazing. The internet's amazing. We're all in different locations. You're on an island, and yet we can all talk to each other perfectly fine. We've got a couple of questions, and if you have more questions, feel free to put them in the chat. I take them in the order in which they are there. But Glenn is asking, what is the high market? And I'm not sure that I'm familiar with that term, but what is the high market like in terms of buyers? Are you seeing in residential a lot of cash buyers, or are they mostly finance buyers?
Mostly financed, because the price point is so high. So even fixer-uppers are selling at $1 million plus.
All right. And Ashish is asking, how do you identify properties to purchase? What is your conversion rate?
So typically, it depends on what my goal is. So if I'm trying to do a fix and flip, I have to get deeper discounts. And usually those I have to find off market because they can get their best price on market. And so I will pull foreclosure lists. A lot of my deals that I get now are through referrals or partnerships. So I don't really have to go searching for the deals. And really, I think it just comes down to what you're looking for. So now I mentioned that I'm moving into the commercial realm. So I have a few fix and flips that I am wrapping up. However, for me, being able to expand into these other markets has been super beneficial because there's a lot more homes. Here, we're very limited on Maui. I think we go some days without any new listings. So it's very difficult. I don't know if I
So
answered that question.
I think so.
Okay.
I was going to ask you a little bit about your debt fund. So you're working with a group that's doing a debt fund now. Tell us a little bit about that.
Yeah, so I'm working with Rise Capital Investments with Emma Powell and
Oh yeah,
Chris Borden. Yeah, Emma. So
Emma
she's
from
been doing
Idaho.
it for a while. We had connected. I was actually talking to one of her partners who had started lending on projects. So I was looking for them to lend on one of my fix and flip projects. And he was like, hey, you should start investing in commercial real estate. I was like, oh my gosh, I don't have that much money. So the same idea, right? I never even looked into it because it wasn't in my realm of what I was trying to do. I was thinking, okay, I'll JV on everything, joint venture. So like partner with one or two other people and we figure out some creative strategies on buying these bigger deals. And like you guys know, with any partnership, it's almost like a marriage and relationship. So for me, thinking about like partnering with, like 50 other people on these syndication deals, it's like, oh, how does that all work? And so I think I just educated myself, surrounded myself by these people that had already been, had experience in the field. And then they brought me on mostly for the marketing aspect because I do have a broader reach and was able to raise a few million just on my own. And so for that fund, I think it was important for us to have the debt aspect because we had already noticed. We just started it maybe about 4 months ago, but we had known each other for a couple years, invested together and negotiated the GP portion of some other deals because of the amount of money we were able to raise. So we're like, okay, let's just start our own fund. And for us, like I mentioned before, I had wanted to, my whole goal is just at the end of the day, like put my money somewhere and not have to worry about anything else, like the renovations, the property management, and finding the deals. Like I really like that aspect of capital raising, but you still have to stay in tune with how the deal is doing. However, just having those partners and then slowly investing in these deals and through our fund, we get the option of either offering them, a straight return or, taking the bigger risk of investing in these equity deals. And so, I mean, you're in tune with everything happening right now. And a lot of people are having capital calls. A lot of people are struggling in the multifamily space. So I think for us having that debt side of the fund is definitely a benefit to give options to our investors.
Is it mostly first position liens that the fund is taking?
Uh, no, it's
Okay,
second. Mm-hmm,
second liens. Oh, that's interesting.
mm-hmm.
And do you know how the other people on the fund are finding the deals and originating them?
So it's
Not originating. That's a specific term. How are they finding them?
So just finding them through networking. So we
Yeah.
have we run them through financial metrics, like you had shown in the beginning of this call. One of our partners, Chris, does majority of the financing. He was the CEO of a huge company here in Hawaii before. Now he lives in Utah, and that's how him and Emma connected. But really, we
Was
just
that
look.
Chris Parmelo?
Oh, Borden.
Borden. Okay.
Yeah. So
Cool.
I honestly just leverage other people's experiences and expertise. And I focus what I'm good at, which is the connections. And that's how we connected too
Yeah,
on LinkedIn.
that's true. I knew Emma too. I'd been periodically in and out of her club for a couple of years. Um,
Yeah, her
I
story is
think that's why
amazing too. If you
I
guys
met
know
you.
Emma Powell, you could look her up on LinkedIn too. She just quit her job, started traveling the US with her family, and is just living off her passive income right now. And then, uh, participating in the fund as well. But I think she just like hiked, I don't know, for like 150 days.
Oh my goodness.
Yeah, through this huge
Sounds nice.
trail with her husband and then their like two kids and their dog. I don't know. It was wild.
That's
But
a great way to lose weight.
The
yes,
Appalachian Trail.
yes. It was long. She
Yeah.
was gone for a
Yeah.
while.
Appalachians, what, the whole trail is like 2,200 miles.
Yeah. People will be gone for months when they do it.
Mm-hmm. Yeah, she was gone for over 3 months, I remember. So I was like, Wow.
All right. Am I missing any questions that were in the chat? Admittedly, I've got a bunch of direct messages in here as well, so I might be missing your question. If you have a question, why don't you take yourself off mute and just ask? We've got a small, comfortable group here. Okay.
Hey, Sasha. I know you said you leverage others. Do you use wholesalers as one of your conduits for hunting?
Yes. So I have not purchased directly from a wholesaler just because I can find deals directly from the sellers, but I'm always open. So I've talked to wholesalers, ran numbers with them, but never have bought one from a wholesaler.
Okay, thanks.
Mm-hmm. Is that something that you do or you look into?
So typically I see finder's fee type wholesalers, right?
Mm-hmm.
And their fee isn't that terrible in the realm of what the dynamics are of the deal itself, right? Whether they're really going to pencil with decent NOI. It's usually the sellers that are much more price wise still believing that gravity doesn't actually exist.
Yeah, I think that's the issue too with a lot of wholesalers is they don't get the deals deep enough, so it doesn't work out for what my projections are either.
Yeah, I've given like really specific criteria of what I want, and then they're supposed to come to me with something that's going to work within my my parameters. And you're right, I see quite a bit of, well, it didn't actually match, but I'm going to bring it to you anyway, hoping you'll bite.
Right. Well, good job for taking action.
All right. Any other questions for Zasha?
Hey, Sasha, I had a question as well. I was just wondering, what is your take? You've got rising interest rates, you've got sort of reducing rents, you've got oversupply in the short-term rental market. How are you taking all of that into consideration as you invest looking forward in new properties?
So for us, we have to get things at a deeper discount and really look at, I mean, nobody can predict where the interest rates are going to be, in 3 to 5 years. However, we are really trying to make sure that we secure the debt up front. So if we can get some sort of seller finance, or we can get them to offer, some buy downs in the beginning, or even invest in things that don't really need too much work, but have a lot of equity. And it's just finding deeper deals. I think a lot of the investments, the apartment buildings that we did invest in 2022 were ones that were like new builds, and then also ones that had very little renovations to be done. It's just some updates, and if the seller was in some sort of distress and needed to sell quickly or move money into a different project, that's the kind of situation they were in. And so I think just being mindful, like I mentioned in the beginning, of okay, what else can we do as well? Like if we ended up keeping this property, or our investors all had to come out of pocket in order to save the deal, what would that look like essentially? But I mean, diversification. That's why I started, like, I fix and flip still. I have my own personal rentals. I invest, in other people's deals, and then I invest also in our own fund. And so I think the more that you can spread your money around in different types of investments, even though it's all real estate related, then the more cushion you have if one were to fail, to come back. It's a very general answer, but diversify.
Okay. Any other questions? And if not, I'll just have everybody take themselves off mute, and thanks, Zasha, for coming in and speaking to us today.
Thank you, Sasha.
Thank you.
Thank you.
Thank you.
Thanks,
Thanks,
Sasha.
Thank you.
Thanks, Sasha.
Thanks, Sasha.
Thank you, Sasha.
Aloha.
If you're ever in
Aloha.
Hawaii, hit me up.
Thank you,
Hey,
Zasha.
you're in Maui?
Will
Yes.
do.
Okay. I may be there soon. I will look you up. I think actually I'll connect with you. Thank you.
Yeah, no problem.
All right, everybody. Have a wonderful Veterans Day observed and a great weekend. See you next
too.
week.
You too. Bye.
Thanks, Daniel.
You too. Thank you, Daniel.
Thanks.